is the example I usually used for arbitrage is, you see gold in New York at $1,200 and it's selling at London simultaneously at $1,201. Well, an arbitrageur sitting on a trading desk someplace will see that and buy up gold in New York at $1,200 and push the price up a little bit. He'll simultaneously sell gold in London at $1,201, push the price down, and they'll convert somewhere in the middle, and it'll happen so fast on a trading desk that you don't really even get to see that. But what if I told you could buy gold in New York today at $1,200, and sometime in the next 2-3 years you're going to make money, but you could lose 20% of your money while you're waiting? There's no guy sitting on a desk anywhere that really can do that. And frankly, time horizons are getting shorter. It used to be, when I was younger, I used to get quarterly statements and most people would throw them in the garbage. Now you can check your stock price 30 times a minute on the internet. Maybe some of you do. And time horizons are shrinking. And we're just playing time arbitrage. We're being patient, buying cheap, good businesses, and waiting for the market to recognize the value we see.
Hey, it's Tom here, and welcome back to the channel. So you heard it there from Joel Greenblatt in that short clip from a lecture he gave at Google, actually. Joel Greenblatt said, we're just playing time arbitrage. We're being patient, buying cheap, good businesses, and waiting for the market to recognize the value we see. And that actually reminded me of another quote from another very well-known value investor, being Seth Klarman, where he said the single greatest edge an investor can have is a long-term orientation. So in this video, I want to talk about that concept of time arbitrage as it relates to value investing. Why do these opportunities even exist, and how can we potentially make money from them? And I also want to talk through some examples of time arbitrage situations that have happened in the past where short-term events have taken place, which creates opportunities for long-term investors. And we'll kind of talk through what happened in each of those situations. And I also want to focus on some areas of the market where I've been looking at over the last year or so where I think time arbitrage opportunities may be present. Now, these aren't intended to be stock tips or recommendations to buy or sell stocks or anything like that, but I just want to talk through some of those examples. It's one thing to kind of look back at situations that happened 2 or 5 or 10 years ago in terms of some of these dramatic short-term events that created great opportunities, and those are always good case studies, but it's an entirely different thing to try and assess those things as they're sort of playing out right now. So that's the topic for today's video. Before we get into that, actually, on the punch card investing stream yesterday, we got a question on basically what some of us on that live stream channel do for a living and what we also do for fun, and we've revealed a few of our special maybe talents, maybe mediocre skills, but we kind of set a bit of a challenge on that video and said if we can get 500 likes on that most recent live stream we did over on Punch Card Investing, then we will each reveal our special talents and give you a bit of a demonstration. So I think Frank's going to show us his jiu-jitsu skills. I'm either going to pick up some heavy object or maybe play a song on the guitar, and I think Brad's going to give us some gardening skills. So if you're interested in seeing that kind of stuff, definitely jump over to the most recent stream on Punch Card Investing about share buybacks. Give that video a like, and if we hit 500 likes on that video, you will get to see our special talents or somewhat mediocre skills at things other than making YouTube videos. Okay, so firstly, let's talk through why some of these time arbitrage type opportunities exist in the first place, where long-term investors can buy something at a discount purely because there's a whole bunch of short-term focused kind of market participants pricing it really attractively for long-term owners. Now, I'm actually going to throw out another quote here from another famous value investor, that being Charlie Munger back here. And Charlie Munger very famously said, "Show me the incentive and I'll show you the outcome." And that is basically what it comes down to when you see a lot of this kind of shorter-term behavior in the stock market. You have to understand that most of the money that is present in the stock market is managed by professionals, and they are really the ones that will move the market up and down, particularly in the short term. Over the long term, we know that companies basically track their underlying intrinsic value, and the underlying performance of the business will drive what happens with the stock price. But in the short term, really anything can happen, and it's very largely influenced by professional investors. And in many cases, professional investors are basically almost like momentum traders. They're kind of buying into stocks that are going up and they're selling out of stocks that are going down. And one of the big reasons that they are doing that is because they are benchmarked very, very frequently. One of the things Joel Greenblatt said in that clip I played at the start of the video is that time horizons are getting shorter and shorter and shorter and shorter. And for professional money managers, it basically means that they really need to have performance every single quarter that roughly matches what their benchmark is doing, what something like the S&P 500 is doing. And they really can't afford to be in stocks at all that have the potential to go down 10, 20, 30, 50% in the short term, even if the long-term returns look attractive. And for that reason, anytime there is some sort of event going on with a particular business, even if it is really short-term in nature, you really see a lot of selling from institutional money managers, and it can really drive prices down. And you see this sort of unfortunate consequence for the professional money managers of them basically having to buy stocks high when they're going up a lot, and they're having to sell stocks low when they're going down a lot, because they can't stomach it going down even further for their quarterly benchmarks and so on. And in some cases, selling out of these businesses is actually a good move. Not every time that a stock goes down, it's going to be a buying opportunity. It's not always going to be a short-term event where once the business kind of gets out the other side of this, it's going to be okay. Companies do go bankrupt, and that is kind of the key distinction here. You can't just buy the dip on everything. You can't just buy any stock that's down because, it's trading at a lower price than it was a couple months back. You really have to understand the business itself and the event itself, and whether you think that company can come out the other side of that event okay. Okay, so let's talk through some examples of these short-term events where something's happened to the underlying business. The stock has basically tanked in the short term, and they've turned out to be really good opportunities for long-term investors. So I'm going to give you 3 examples of those that have already played out, and then I'll give you another 3 examples of scenarios that are potentially playing out at the moment and just kind of areas of the stock market that I'm currently quite interested in. So our first couple of historic examples actually both come from Phil Town. Now, Phil Town is the first person that I sort of heard about this events-based investing from, and he's got some really good examples from his own personal portfolio that he's kind of accumulated over time. And the first sort of classic example that he brings up all the time is his beloved Chipotle Mexican grill.
Oh my god, I love Chipotle! Chipotle is my life!
Now, if you've ever listened to anything from Phil Town, you've probably heard him talk about Chipotle Mexican Grill because he's had success with it a couple of times. He was actually buying it at about $50 a share back through the financial crisis, sold out of it at $500. Probably about 5 years or so later, and then actually due to the event that I'm about to talk about, he got another opportunity to buy back into Chipotle Mexican Grill. So here's what happened at Chipotle. Now in 2015 they had more than 200 people actually get sick due to a food safety scare. They had norovirus in some of their restaurants, so over 200 people got sick with norovirus after eating at Chipotle, and over 80 of them actually came from one specific Chipotle restaurant. Now, that's clearly not a good look when your whole brand is sort of fresh, healthy, organic food and so on, and people are kind of getting sick from your restaurants. And that got a lot of investors, and particularly short-term investors, like I say, selling out of Chipotle very aggressively. So that food safety scare actually happened in 2015, and for the next almost 3 years, Chipotle just kind of kept going down. From 2015 to 2018, it went down 65%, and as this was all playing out, back in 2018, I actually specifically remember listening to a Phil Town podcast, and they were talking about Chipotle. And at the time, Phil Town thought Chipotle was worth about $500 a share. Typically, he likes to buy at about a 50% margin of safety, so his sort of target buy price was about $250 a share. I think at the time the stock was in the low 300s, and he's sort of like, it looks pretty attractive, but I don't think it's going to get all the way down to $250. And he was wrong. It actually did continue downwards pretty quickly, and he got a chance to buy it at about $250 a share, and it played out extremely well. The brand of Chipotle was largely undamaged after they were kind of through that norovirus scare, and if you look at the stock today, it's close to $2,000 a share, so from $250 to $2,000. I know Phil Town actually sold at about $500, so he certainly didn't capture all of that gain, but he still got a nice double out of Chipotle in a fairly short space of time. Another pretty similar situation and another short-term event again from Phil Town is one that he also talks about quite a bit, which is Gildan Activewear. Now, Gildan Activewear is basically a low-cost producer of t-shirts and clothing. So they sell t-shirts into places like Walmart, for example. And the whole business model with Gildan is not to sell high-end fashion or anything. It's just to sell low-cost, basic clothing products into, these big box stores. So back in 2012 with Gildan, there was actually basically a bubble in cotton prices, and the price of cotton to produce these t-shirts just absolutely went through the roof. There was a cotton crisis in Egypt. Cotton yields were very, very low, and therefore the price of cotton went up a lot. And that is kind of like a classic short-term event, a one-year event. If you're relying on sort of a seasonally grown crop and, there's a bad year for that crop, you're going to have a pretty bad year for your business. And Gildan's CEO was actually coming out, and you can look up these old annual reports from like 2012. And you could see that Gildan was saying that they were going to have a pretty rough year, but the fact that cotton prices were so high was a pretty great incentive for farmers in other parts of the world to start to grow cotton, which would, of course, bring the price back down to more normal levels. So pretty classic kind of short-term event. The stock went down about 50% as this was all playing out through sort of 2011 to 2013. From the bottom, it was actually a 3x, so it recovered to its initial price and more after this crisis had fully played out. And the last historic event I just want to talk about quickly is basically anything finance related back in 2008 and 2009. I wasn't investing at that time, but from what I've seen and what I've read, it was an extremely scary time. And this was one of those situations where you really had to be, I would say, in the know and be a very good sort of bank analyst or financial business analyst in order to really understand whether this was just a short-term event or whether it was something that would permanently impair some of these businesses. Because we did see a lot of companies go bankrupt through that time. But one of the businesses that did not go bankrupt was Bank of America. Bank of America, from 2006 at its peak through to 2009, was down 94%. It was down a massive, massive amount. And this is where we saw some of the all-time great investors like Buffett at Berkshire Hathaway and also Charlie Munger via the Daily Journal Corporation buying into stocks like Bank of America, which are now up close to 1,300% from the bottom in the financial crisis. So those are some great examples of historic events that have happened, but of course, it's hindsight is 2020, and it's easy to see that those would have been great investments kind of looking back at them now. Much trickier to kind of do it as they're playing out and try to pick through kind of the different selection of companies that are down a lot and that have been beaten up, and try and figure out which ones are potentially good investment opportunities. So like I say, I just want to give you 3 that I'm kind of focusing on at the moment. I really want to reinforce that this is not me saying to go out and buy these stocks or anything, but I think they're interesting areas to kind of study and figure out in your own research. Now, the first company is actually one called Seritage Growth Properties, and this is a stock owned by Monish Pabrai and Guy Spear, and it's one that I also have in my own portfolio and one that I've covered a few times here on the channel. And Seritage is a really classic example of where I think there is a potential time arbitrage opportunity. So if you know the story at Seritage, you'll know that they have a bunch of retail stores predominantly that were initially spun out of Sears before it went bankrupt. And they're basically going through this development process of still sticking in retail to an extent, but also building out other types of real estate. So building out, multifamily, building out life sciences, to a smaller extent now, some office space, and trying to sort of diversify the portfolio, intensively sort of densify it in certain assets that they own, and also dramatically ramp up the rent that they're getting per square foot. And that's sort of the long-term vision. So if you're a shareholder in Seritage, that's really what you're betting on. And once they get to that point, there will hopefully be some nice positive cash flows that offer good returns for shareholders. But as it stands right now, it's one that is really, really easy to just dismiss. And it is still down a lot from kind of pre-pandemic levels. It's come up a fair bit from the bottom. It's been about a 3x from the bottom, but it's still down a lot overall. And like I say, it's kind of just really easy to push to the side. It's in retail real estate, which not a lot of people like. It's very much getting beaten up at the moment. They're losing money as they go through this development phase because they're spending a lot on capital expenditures. They've got a fair bit of debt from Berkshire Hathaway, and they also just kind of have this, I think, taint sort of over them still as being spun out from Sears. And I guess that is still kind of seared, no pun intended, into the back of investors' minds. Now, the next company I've been following that has certainly been going through some turmoil recently with their business is the A2 Milk Company here in New Zealand.
Oh! Somebody! Oh! He needs some milk!
And it's again one I've been following on the channel, and one I have a small shareholding in as well. And again, it's just a really easy company to kind of throw in the trash, and particularly after the price has gone down a lot, I think that really deflates kind of a lot of investors' confidence, in terms of putting money into some of these businesses. But if you're a long-term investor, potentially some opportunity, but again, do your own work on that. So again, A2 is kind of easy to dismiss. They've got a lot of disruption in what they call their Daigou business. Due to lockdowns happening fairly consistently now, particularly in Australia, they also had some very large kind of inventory write-downs. Basically, when the pandemic first started, they had a lot of individuals kind of stocking their pantry, and it's taken some time for that pantry to kind of get destocked, which has resulted in sort of less overall sales for the A2 Milk Company and a pretty big hit in profitability, and also quite an aging inventory in terms of their infant formula that the A2 Milk Company have. So they've written down a lot of that inventory, and a lot of it has actually been destroyed in order to keep the average age of that inventory and of the final product people are getting, relatively fresh. But it's a capital light business. Up until the last year or so, it had a spectacular record of growth and has literally zero debt. So it's not like it's some debt-laden commodity company. There are commodity kind of elements to A2, but I really don't believe it's a pure commodity business. And like I say, they have no debt. So I think it was Peter Lynch that said, sometimes people forget that it's pretty hard to go bankrupt if you don't owe anyone any money, and that's kind of the position that A2 Milk are in at the moment. They're certainly having some big headwinds with their business right now, but they've got a fairly indestructible balance sheet. And finally, and this one will come as no surprise to probably anyone, but the other stuff that's kind of in the dog box at the moment, where I think there's potential opportunities if you're willing to do the work and try and understand some of these situations, is basically anything from China. I think China stocks in general have just kind of been painted with the same brush, and even when you have really strong businesses, they're basically all been hit almost equally as hard. So there's a lot of stocks down a lot at the moment, Alibaba, JD.com, Pinduoduo, the education stocks, that one probably is for a very good reason. Potentially, there's good reasons the other stocks are down as well, but it's something that I think is worth a look. It's sort of, I would say most of this kind of started with a couple of key events. You had Jack Ma's speech and kind of his disappearance for a while there as well. You had the Ant Group IPO get halted, and you've had, like I say, these continuous kind of crackdowns in education and tech, and there's no sort of end in sight in the eyes of a lot of people for some of these regulatory crackdowns. But like I say, if you're willing to do the work on some of these industries and try to get your head around some of the situations, there's obviously no guarantee that any of those potential things playing out that I mentioned just now are guaranteed home runs or guaranteed successful investments, but I think they are really interesting places to study. So that's it from me for this one. I do hope you enjoyed that video on time arbitrage and why some of these situations appear in the first place and how we can potentially take advantage of them. So like I said at the start of the video, if you want to see some of the Punch Card Crew's hidden talents, definitely jump over to our most recent live stream on share buybacks and give that a thumbs up. If we hit 500 likes on that, you will see some of our skills in various different aspects and hobbies that we all sort of have. So that should be a fun one if we can reach that target. That's from me for this video, and I will see you in the next one. Cheers.